G'day, Brian.
Hi, Woody. How you going?
Yeah, good, good. It's been a while.
It has been 2 weeks since we last talked, but
Oh, 2 weeks. Feels
yep,
like it's been a
and
lot
about a
longer.
month since we last caught up face to face.
Yeah, yeah. That was a good day. That was a good day. We both discovered our love of various different red wines,
Yep,
which I think is going to be of benefit to your readers because one of the benefits that hard money trader readers and lifetime members of Rockstock Insider had an into was a podcast which was called Bullion and Bourbon, but we've got an idea to call it Bullion and Beaujolais or Bullion and Bordeaux, one of those. And it's all going to be about discussing gold while drinking red wine.
yep, and I look forward to it. And I
Yeah,
hope other people, all those subscribers who join in, are going to have a glass of their favorite drink in their hand.
yeah, they will. That's a prerequisite, right? So, gold market. What's gone on, Brian? What's the latest?
Well, I think quite a number of us saw the beating of the price of gold in the last 2 weeks. I mean, it's fallen about 5% in Australian dollar terms since the beginning of the month when we had the peak at about 24.50, and we're at about 23.70, 23.80 right now. In US dollar terms, I think it's been hit a bit harder. It was up about $1,810, and now it's about 1780, and the worst it was at was 1763. Now, I would not blame people to basically go, are we back in where we were at the beginning of March? The good news is we're not. In fact, we're actually a bit higher up than we were at the March lows. I think we're still about 5-7% up in the price of gold. As for gold stocks, I know some of you had a rather, and I also experienced it too, very rough ride since the end of June when since the end of May when the stock index was about 7,500, the Australian, the ASX gold index.
Yeah.
And we saw the bottom at about 6,600. So that's been quite a rough ride. Now we're still 10 to 12% up from the March lows. What's actually happened is that the Federal Reserve came out last week and they were saying how they think that inflation is starting to heat up, and the Federal Reserve is going to need to take a more hawkish position, as in to become a bit more hands-on about controlling inflation. Now, I was listening to a talk yesterday on, I think, Palisade Radio, and Adrian Day brought up a very interesting point about the way media frames what's going on, because they talked about the FOMC, the Federal Reserve Open Market Committee, saying that they're going to be hawkish about controlling inflation by perhaps raising rates in 2023. Adrian Day's argument is, if the media actually says Federal Reserve will not be raising rates until 2023, would you see the price of gold going up? That's a question that I'll pose to our subscribers just to think about it. It's not the event that happened, it's the way people actually talk about it. Now, if you're like me, and in the last few days, I've been talking about how we had the quadruple witching day last Friday, where the derivative market is supposed to close off their contracts for the quarter. And that usually leads to very heavy selling of mining stocks, commodities, by fund managers, etc. That's a great time to buy. I bought a bit in my portfolio. I also advised some of my subscribers to hold their ground last Friday in Rockstock Insider, just to let them know, don't panic if you see the price coming down. This is not a time to sell. And I hope that most of them indeed dug their heels in and allowed themselves to let this thing pass. As you can see, the price of gold has actually gone up about 1 to 2% in the last 2 days. So you may have actually found a recent bottom.
Yeah, right. So what else makes you say that? Because so you're talking relatively short term, right? Initially, but I know we've just released a report which you've entitled "Why Australia Could Be the Epicenter of the Biggest Gold Bull Market in History." Now, I'm assuming that's a longer term view.
Yeah.
So you think this is a good entry point for people?
I think it's a great entry point from a short-term and a long-term perspective for the following reasons. Now, I'm working at the moment to analyze, and I think this is the first time someone's doing it, the seasonal effects on the gold price. Which months are good months to buy, and which months are not good months to buy gold in Australian dollar terms. There are several studies in US dollar terms. Now, in the short term, July, August, September are good months for gold. Same with around January and February. Now, for the longer term, there is a significant opportunity to see the price of gold and silver rise. As I said before, the Federal Reserve doesn't look to raise interest rates, and I'll repeat, doesn't look to raise interest rates in the next 2 years. So with that, they can talk all about how they're going to control inflation, and they're not going to do anything about it. It's like a teacher saying to a class that refuses to listen, I'm going to put you on detention, without ever putting them on detention until the bell rings for lunch. How potent is that teacher? The student, if I was a student, I'll take the piss on the teacher and go, I'm going to call you out on this, right? So rather than calling out the Fed and actually force them into action, go and buy. I'm going to buy gold. I'm going to buy gold mining stocks with what I get in my paycheck. And I'll talk about what I'll do. You can decide what you like to do. Great opportunity. Look at the price of oil. It's gone up from $36, $37 a barrel since the US election last year to $73 a barrel right now. If that's not going to push up inflation, I don't know what will. Now, there's people, I understand that copper has come down about 15% from its peak in the last month. And some are saying maybe inflation is transitory. But how transitory could inflation be when you have governments around the world saying they need to revive the economy after the massive lockdowns we had last year? All those lockdowns is going to reduce productivity, and you're printing currency, to try to spur the economy. Your printing currency is one thing. Creating real productivity in terms of goods and services, you can't print productivity. And in some cases, factories have been closed for quite a while, and people don't want to come back to work simply because it's more comfortable receiving paychecks from the government for staying at home. So I don't see inflation as transitory, and the Federal Reserve gave it away when they talked about this last week. It's just that the media framed it another way and said, oh, they're going to be more aggressive in controlling inflation, but not in the next 24 months. So
you're essentially expecting an inflationary shock, which is obviously always historically been positive for the gold price, right? Yeah. But so the basic argument, right, is from the way I'm hearing it, is that they're printing more and more money. Productivity is getting less. So you're essentially going to have more dollars chasing the same amount of goods. Yeah,
that's exactly right. Forget about the CPI. Forget about what they talk about in the news headlines. I saw someone post on Twitter, $9 a kilo for tomatoes in a grocery store. And you're telling me that's 1% per annum inflation? Gotta be kidding me. People can feel inflation in their hip pockets when they go to buy groceries. No matter how much cash you're going to print, that doesn't lead to more apples and more tomatoes growing on a tree. You can fudge around numbers. You can't fudge around with nature.
So that's largely stemming from the Fed. How's the RBA responding to all this?
Well, the Reserve Bank of Australia, I think people were initially expecting that Governor Philip Lowe the next move in the interest rates would be upwards, except they've been talking it down. They've been sounding more dovish with each month that passes. And in the beginning of this month, it sounds like they're again pretty dovish, and they're going to sit on their hands about wanting to raise interest rates. The next move could well be another 0.05% decrease or 5 basis points decrease in the interest rate to. I mean, we're currently at 10 basis points, where you can't really. You think you can't go any lower, but we'll probably be able to go lower, or they're going to announce some form of stimulus package somewhere along the way, depending on who wins next year's election. But I think whether it's Scott Morrison or whoever runs the Labour Party, I'm not sure whether they're going to put Anthony Albanese to run for election. He's had his run. The poll numbers look terrible. And I'd say if the ALP puts up Albanese, Scott Morrison is going to basically just romp home much more than what we saw even with Tony Abbott in 2013. For better or for worse, whichever party you're going to get to run the government, they're probably going to need to keep the market juiced up and pay people to stop prices from falling. So it's going to look, I do expect in the longer term, precious metals, property, stock markets, they should be going up. There may be a few bumps along the way.
So what advantage specifically do Australians have when it comes to the gold market?
Well, in Australia, we care about the Australian dollar terms in our commodity prices. And as much as the US appears to be in a weaker position since Biden took up the presidency, and the US dollar has come down, the US dollar is still the reserve currency. It's still the dirtiest, it's still the cleanest dirty shirt in the laundry. So we are not going to see the same thing happen in 2010, 2011, when the US dollar came down, the Australian dollar went up to parity, 1-to-1. I think we're in, like the Australian dollar is going to continue to head downwards. I'd say 65 to 70 US cents would be a realistic range to see it, which would be about 10% lower than what we have now. That actually gives us an automatic 10% boost in the Australian dollar price of gold and also other commodities. So that may be an advantage. The disadvantage would be if the price of oil continues to stay at these levels, that could lead to mining companies having to pay more for running their machinery. And it could lead to cost inflation. So the costs of paying staff to work in the mines are going to be higher. That could eat into the profit margins of mining companies, even as the price of gold appears to be higher in Australian dollar terms.
And also, we're home to probably the most choice when it comes as an investor into mining stocks, right? Especially gold miners.
Pretty much, it's either us or Canada, where we have over 200 gold and silver companies on the ASX. So we're spoiled for choice in that sense. But that being said, I think it would be right to say about 100 to 120 of them aren't companies that most people would want to invest in because they're highly speculative. Some of them are potentially even shell companies that are just there in order to look like they're doing something, but they're actually just used to pay directors their salary and nothing else.
That kind of brings me to something I wanted to ask you to expand on, actually, because you spent a lot of time these past few weeks explaining to your readers your unique method of valuing and, I guess, de-risking the nature of gold explorers. Do you want to talk a little bit more about that? I know you call it your VPN system. Can you explain what it's all about?
Yeah,
because obviously to the uninitiated, when you got 200, 2000, however many gold stocks, how do you tell the wheat from the chaff?
Yeah. So with producers, I use the valuation to profit margin filter. I call it as Woody said, it's a VPM filter. So with producer companies, the idea is that what matters is how much cash flow mining companies generate. And you want a company that is able to mine gold out of the ground or silver at a profit, rather than just taking it out of the ground, but they're actually spending more on paying for the petrol, paying for the maintenance, paying the staff, etc. Now, why do I use a VPM and not the earnings per share or PE ratio, price to earnings ratio, that normal companies would use? The reason is, with mining companies, you may spend $200-300 million to build a mine, but for the purpose of recognizing your profits, you will actually recognize it over 10 years or 20 years. So you can have a company that is profitable in accounting terms, but they're actually they just spent $300-400 million developing a new property. To the wise, experienced investor, a mining company that is just spent a huge amount of cash has high risk, even if it's profitable, and therefore it would be more meaningful to look at the costs, look at how much cash they generate on a year-to-year basis, rather than how much profit they report for the purposes of the accountants, etc. So I look at the market value of the company, I compare it against how much they produce and what type of cash margin they produce at. So mining companies sell their gold, but the margin that they earn is dependent on how much cash they're actually spending paying their staff, running the machinery, as well as also maintaining the mine property. The thing is, as you're mining things out of the ground, you've got to ensure that the ground underneath is sustainable for you to continue to produce. So you've got to maintain the underground properties. And again, that is a cash item, and you can spend it but not report it immediately as profit. So therefore, there is the disparity between the cash surplus and profit. So once we've got that better down, I then look at how much they actually produce and the cost in producing. From there, I will be able to calculate something similar to the price to earnings ratio, but it's based on the mining company's production adjusted for its cost. And I call that the valuation to profit margin filter. It gives me a single number akin to your price to earnings ratio, from which then I can kind of measure whether a large producer is more profitable, not more profitable, is it good value at the current share price compared to another one? And for what reason is the market pricing this producer better than the other? And I try to level it out by taking into account its production, its costs. And after all that is leveled out, I can then go, okay, this company looks cheaper than the other, but I also will consider non-numerical factors such as management quality, how good the grades are in the ground. So because a gold mining company with better grades is going to attract a higher profit margin, simply because they can process less rock to get the same amount of gold. So if you're a subscriber, I'll give you a more detailed explanation, but hopefully this one's enough to get you interested in finding out more about this service, and you can join Rockstock Insider to get more detail.
Yeah, but it's definitely a really fascinating way of looking at things. But how would you say it enables you to whittle down? Does it whittle down like 100 stocks to like 5 that you find are really compelling, and then you make some more judgments from there, or what?
So there are about 25 to 30 producer companies in the ASX, and how do I work out which ones I would consider? That VPN filter helps me to line them up and tell me which one I should actually invest in now, which one is greater risk and which one is lower risk in terms of sometimes a company that looks cheaper may not necessarily be a better one. I then have to dig in further. So it's the same thing with the P ratio. How has it helped me in the past? I actually, especially in 2014, when when this entire gold mining industry was at its bottom, and you had Newcrest mining priced at what, $8? Newcrest shares were $8, and St. Barbara was like 7 cents. The numbers that I was getting in the using my VPN filter, it was ridiculously low. And almost every company that I held and bought during that time, in a matter of 12 to 18 months, they went up by triple-digit percentages. Now, right now, the prices aren't as low as in 2014. So I can't tell you now, if you buy anything, you'll be able to get triple-digit percentage returns. But I will be able to separate companies which I think have a better potential to deliver 50% returns in the next 6 months, and which ones you're probably going to get about 10 to 15% because they're fairly priced.
And what about the explorers? Do you use a similar thing for the explorers, that maybe they don't have any cash flow, right? Because they haven't even got anything that they're producing.
Yeah, it's a great question, Woody. For the hard money trader subscribers, I use the enterprise value to resources and reserves multiple, but I also add to that, adjusting it for the grades that they have in the resources and reserves. Now, the enterprise value to resources and reserves ratio, that's just saying, if you buy the company at this current price, how much are you paying per ounce of gold or silver or minerals beneath the ground? And there are rough industry averages as to where these companies should be trading around. Now, I add to that, adjusting for the grade of the resources beneath the ground, because, as I said before, if you have better grades, your processing plant doesn't have to go through as much rock in order to get the gold, and therefore it's going to be more profitable. The industry, no one in the industry has really been doing that, and it's allowed me to differentiate between the high grade explorers and the lower grade explorers to see whether I can level them on the playing field and compare them. So that's why I was able to identify companies that I've recommended to my subscribers in Hard Money Trader, such as Musgrave Minerals. They've got very good grades beneath the ground, about I think 3.2 grams a ton, but there is actually like a third of the deposit that they have is 16 grams a ton. That's half an ounce of gold beneath the ground, and it's actually quite close to surface. I expect to see Musgrave to do very well as the price of gold goes up.
Yeah, cool. Have you what about the sort of boon for producers then over the next 12 to 18 months in Australia? You know, we also know that we are on course to becoming, I don't know, are we on course to overtake China as the #1 gold producer at some point?
I actually saw someone tweet this somewhere, or it was in a news article, in one of those mining investors news article. So it is likely that Australia will overtake China as the biggest producer of gold, and I think it will be like more than 300 tons per annum. And the reason being is that there is a lot of development going on in the Pilbara region, as well as also in northern Queensland, I heard, and some parts of eastern goldfields in Western Australia. So This, in fact, today, Degree Mining just announced that they have 6.8 million ounces of gold in the Hemi deposit, which brings the total amount of resources under their in their properties to 9 million ounces. Now, Degree is an explorer at the moment. They have $87 million of cash, and the market cap is about $1.7 billion. It's huge. Chalice still hasn't reported their resources in the Julima project, and that is expected to be another huge one. Could be in the above 5 million ounces once they actually put it out in to the public. So you can expect that there is going to be a lot more production coming from new producers. While I do note that existing producers, the grades are coming down a little bit. Almost every key mining company that I've seen on the ASX, their grades are coming down. And some of them, I think, are needing to increase the amount of ore that they process. So they're going to have to expand their processing plant in order to keep up with the production. So that's something to also keep in mind, that grades are coming down and companies are going to have to spend up on expanding their processing capacity.
And against all that, you got the backdrop of an inflationary environment that we're heading into. So would you say that that would affect the supply maybe of gold coming on in the years ahead, just when demand is going to get a lot higher and the inflationary forces are going to get stronger?
I think there is a possibility, because in the last 3 years, I have actually been collecting data on the mining costs and the production. And while the price of gold has gone up in Australian dollar terms from about 1,500 an ounce in mid 2016, mid 2015, it was about $1,500 an ounce, and the average all-in sustaining costs for mining companies were about $1,100 an ounce. And I was thinking, wow, if the price of gold increases to $2,000 an ounce and the average is going to be about $1,100, these mining companies, these producers are going to be literally printing cash. Now, that was half true. The price of gold increased above $2,000 an ounce in mid 2019. But the average AISC has actually gone out to about $1,330, $1,350 an ounce. And if you have a look at the lowest cost producers in Australia, Evolution Mining, Kirkland Lake Gold, Regis Resources, Northern Star. Now, Northern Star and Regis has actually, their costs have gone up about 30% in the last 2 years. So their margins have actually not increased by as much. And even Evolution Mining, they're producing about $1,150, $1,200 an ounce. And there's only really one or two. I think only really Kirkland Lake Gold is producing at less than $1,000 an ounce inside Australia, but they bought Detour Gold last year, and that's a higher cost mine because they do bulk processing. So yes, there is going to be you should not expect that mining volume for each company, individual companies, is going to maintain itself as it is now. The production in Australia will increase because you have more mines coming into play, rather than the players now increasing the production with what they have. That's why they're actually going and buying up mines, and also buying up explorers to increase their deposits.
Cool. All right, Brian. So what are you sort of looking at for the next couple of months or so? Let's finish up on that one.
Yeah. So now that the quadruple witching day is over for the month of June, I do expect that the price of gold and silver to start heading upwards into July, August, and September. I'm looking forward to seeing the June quarterly results for the producers, and they'll be released in July. I expect that AISC for most of these companies to be up about 5-10%. So that may put a bit of a dampener on the rally, and the price of gold should should look quite bullish. So that should actually see some excitement. So it's a little bit of it's more like 2 steps forward, 1 step back in terms of producers. For mining developers, I'm waiting for Black Cat. Black Cat's gonna start, I think, building a mine, and I think there's a couple of developers that are also coming in, and Capricorn Minerals is now starting to produce as well. So there's a few more producers that I'm gonna have to keep an eye out on and see whether they're worth recommending to my subscribers.
Cool. Thanks for that, Brian. It's been fascinating talking as always, and I will be hitting you up for another one of these very shortly.
Excellent. Thanks, Woody. And I hope all the subscribers keep well, keep warm, especially this winter. It seems to be particularly cold.
I know. I'm doing the whole cold shower thing at the moment. It's not been pleasant.
Well, it's good for your health. I don't think I can do it myself, though. Not quite up for it.
Cool. All right, Brian. Thanks a lot. And I hope you enjoyed this, everyone at The Insider. Cheers.
Thank you.